It's that time of the year when all the market attention would be centered around the budget. Budget for Achhe din. That's what we are calling it on ET now. So what exactly could this budget do to kickstart the investment cycle, change the sentiment and make life easy for entrepreneurs? To discuss all that and much more, I have a very special guest. Sunil Singhania of Reliance AMC, market veteran and someone who has an impeccable track record when it comes to outperformance. More than 99% of his schemes have managed to beat their respective benchmarks. Sunil, fantastic to have you back on ET now.
Thank you for all the kind words, Nikunj.
Budget for Achhe din. That's what we are calling it on ET now. But do you think this budget will be an important budget and it will mark a paradigm shift when it comes to economic policy, government thinking?
See, as far as the markets are concerned and investors are concerned, they look forward to every budget with a lot of hope. I think by nature, we Indians are optimistic, and rightly so. Obviously, this budget being the first full budget of the new government led by Mr. Modi, and the fact that almost all his ministers have vocably very, very strong sort of statements as far as kicking the economy back to the 7-8% growth levels. I think this budget definitely is something which everyone is looking forward to.
So it will not just be a 100-point Nifty event. This budget will mark as a change in guard, a change in thinking process?
I don't know about this 100-point Nifty because, obviously the fact that we have seen 1 year of very strong performance from the market, to some extent, a lot of the statements, a lot of hope is already been factored in. But yes, this budget can be that budget which can give us a direction for the economy from a longer term, a 5-year, 10-year perspective, rather than tweaking with some excise rates or customs rate here and there, which is normally the case. So from our perspective, we're looking at more a policy statement from a longer term perspective.
So the statement of intent is important, but the curiosity around all budget is always centered around one number, which is the fiscal deficit target. 3.6 is what the earlier administration had committed and indicated to. But this time around, if the finance minister's projections for FY16 are nowhere close to 3.6 or even 3.7, will money managers forgive the FM?
See, frankly, one is this one number keeps on changing. So 1 year back, it was current account deficit, which was the most important number. Now it is a fiscal deficit. I don't think that only one number determines a positiveness or negativeness for the economy. Yes, fiscal deficit number is very important. But from our perspective, we would like to see the composition of the fiscal deficit. So if the fiscal deficit is high, but it is because of planned expenditure, then I think we'll be much more positive than a fiscal deficit being low, but planned expenditure also being low. I think as a growing economy, you can live with a few percentage of fiscal deficit, as long as there is a thought process of ultimately reining it in. So as I said, the planned expenditure number becomes more important for us rather than fiscal deficit being 3.5 or 4%.
So heavens will not fall and hell will not break loose if the fiscal deficit number is not 3.6 or 3.7. That will
maybe a knee-jerk reaction which normally happens, once you see the budget document, that might happen. But I think the finer points are very important. And luckily for this government, a lot of things have also fallen in place. So there is a windfall from external factors, which is obviously oil and a lot of other imported inflation items like commodities falling, and some things which they have done like direct benefit transfer and some control as far as deficit is concerned because of say for example oil and gas being now market determined. I think that gives them the leeway of taking some very revolutionary steps.
So what really could, or what will rather excite markets? Markets are already sitting at historic lows, historic highs, earnings have not caught up, and yet markets are riding this hope train.
See, one is very clear, Nikunj, if you see the corporates, they are still to come out of dumps, and I'm talking about corporates which are more economy linked. So obviously they need to have some oxygen even, now. And I think that is where the government spending comes into place. So for the economy to be kick-started, the government has to now start to spend. And maybe, after this budget, that time will come where they will be able to spend. This budget, the Honorable Finance Minister took upon himself to, stick to that 4.1% fiscal deficit target. And I think that reduced the leeway of the government from taking up major projects. Maybe next year, with the full benefit of zero subsidy on oil and gas, with major benefits of oil at $60 coming in, and also benefits coming in from direct benefit transfer as far as LPG is concerned. I think all that gives a big sort of leeway for the government to spend, and I think that will kickstart the earning season. The other thing obviously is with interest rates so high, it becomes very, very difficult for anyone to spend. I was in Rajasthan for some personal visit, and when you see that the kind of tolls you pay and the interest rates which is prevalent, neither the tolls can come down nor the consumer spending can come down, and as a result the corporates will also not benefit. So I think a combination of interest rates coming down and government spending will be the booster which corporate India needs for the earnings to come back.
That's the ideal scenario, but that scenario can only work on paper. If you go easy on deficit, then perhaps the Reserve Bank of India will not be that happy. If you don't spend right now, the infrastructure stroke investment cycle will not revive. So some would argue that the finance minister is stuck between rock and a hard surface. The headroom is limited and expectations are very high.
I don't agree, Nikunj. If you go back in very recent history, 2003-04, the interest rate cut cycle happened first, and the fiscal deficit hit 2.5% only in 2007. It was not when the fiscal deficit hit 2.5 that the interest rates fell. And the interest rates started falling much earlier. So I think what the RBI governor, is a very, supposedly the best governor, central bank governor in the world, I think he is also smart enough to see the direction. So if the fiscal deficit is a function of planned expenditure, I don't think it's going to be too much of a negative. And we are not talking about fiscal deficit being 5 or 6%. We are talking about 3.5 or 4%. I don't think that is going to make too much of a difference.
You've been bullish and you've been dead right. Are you still bullish?
Yeah, definitely. We are optimistic. At the same time, you have to be careful. I think there is one segment of the market where there is buying panic. So, as I always discuss with my team also, you have to have, foreseeable profit from a company before you invest. So, if you're buying a company at high P, there should be thought process that in the next 3-4 years, the earnings growth for that company is going to be so strong that at least from a 3-4 years perspective, the company looks attractive from a valuation perspective. If you're just buying on hope that some company is going to win some orders in defense or railways or some power or this and that, it's not going to help. So I think what we have to be very careful at this point of time, whether the stock or companies which you're buying have foreseeable earnings visible. I think as long as that is there, money will definitely be made. And for the whole broad market, we're definitely constructive.
Earnings are not there, and right now hopes have become forecast. That's the challenge. If I look at the market behavior is still backing quality stocks, be it consumer names, some FMCG names or some auto names. So at a time when Indian economy is on the cusp of recovery, the market behavior should be backing old economy stocks.
Actually, if you see post-elections, the category of stocks which moved up were, the economy-related stocks. And in fact, there was a lot of churn with people moving out of defensives and getting into so-called, the capital goods, the economy-related stocks. And everyone in the media, the investment circles used to say that, whether it is time to shift from defensives to, economy-related. I think what has happened is exactly the opposite. Because as I said, there has to be a foreseeable profit growth which should be visible. And I think some of the sectors which you named, IT for example, or even pharma, they have shown that consistency of earnings, and in fact in a lot of cases there have been upgrades. So it is that period of time where a market is also looking at some direction as far as earnings is concerned. And as you started, the earnings at least from the economy related stocks have disappointed in December. So the optimism has got deferred to some extent. But it's a matter of time. Once the growth in the economy starts, there will be pockets and there will be companies which will benefit out of it.
So you're betting on the economic recovery. If I look at the construct of your portfolio, HCL Tech is the top holding, followed by Lupin, and you got some exposure to even FMCG names. So broadly, you're still backing IT and pharma, for the moment at least.
No, I think yes, the top names are what you have, said, and that's a public information. But you have to see the construct of the portfolio. See, as portfolio managers, your job is to ensure that taking adequate risk or not too high risk, you generate returns which are superior to your benchmark. And I think that is what our intention is. So if you go down, you will see a lot of capital good names also, you will see a lot of private banks, some sort of thematic bets, whether it be some railway stocks or some other thematic bets. So I think it's across not only one fund but across funds. it's a very balanced portfolio, and we are very, very pleased with the construct of the portfolios.
But I noticed that the quality of your portfolio has changed. Now you're really backing high quality names. Is there a change in thought process?
See, as I said, we have to have, you can say, foreseeable profitability. As long as there is foreseeable profitability, any stock is a good stock. But if you're just betting on hope, then that hope is going to fizzle out. So I think it's a combination, and quality comes at a price. So what you have to also see is that whether the risk reward in terms of returns and the quality matches. And I think the fact that the portfolios have done well even in this bull run and outperformed the benchmarks by a wide margin, I think that gives us confidence that the strategy which we are using is working.
So IT and pharma clearly has worked in the past, and that has worked well for you, especially pharma. Can the P's really expand for that sector? Because ultimately market price is a function of EPS and PE, and for most of the pharma companies and IT companies, P multiples are north of 20.
No, IT companies, in fact, after a long time, the PE multiples of the IT sector are lower than the market PE multiples.
Let's look at TCS or the other ones actually. We won't get into stocks.
Across, if you take the sector as a whole. And the fact is that IT sector, despite all the concerns about currency and euro and this and that, have shown profit growth which is superior than the market returns. So I think from our perspective, IT is a core component of the portfolio because it gives stability, it gives very visible profit growth, and it is all free cash whatever they generate. So it's a core part of our portfolio, and it's worked. I think in pharma, obviously now there is a differentiation. The fact is that yes, the PE multiples of a few pharma companies are high, but the growth in those pharma companies' profitability has also been high. So I think you have to marry the two. Where you have high profit growth, obviously you'll have to pay a slightly higher multiple than companies which there are low growth, and you have to then match it with some, we can say, high growth, but where the profit visibility might not be that high. So I think as a portfolio, that is what our strategy has been.
That Midcap cement is making a comeback in your portfolio. Midcap cement, some would say it's dangerous, and it could be rewarding as well, as long as you get the cycle right.
Why dangerous?
They can be illiquid. The size of scale is not there with them. We've traditionally seen that large cement companies dominate the market share. They call the shots.
So one theme which we have loved in the last 3-4 years is operating leverage.
Okay.
We believe that the power of operating leverage is huge. So companies which have huge capacities and who don't need to spend too much for their sales to double, those are the companies where profit growth will be significantly higher than what anyone expects. I think the cement companies would fall in that bracket. So you have this large cement companies which are also good, trading at $200 a ton, and then you have this. You won't call it small because those companies are not small in terms of operation. These are companies which have operations of 8 to 15 million tons of cement capacities. They are trading at sub $100 valuation as far as their EV to installed capacity is concerned. But the moment you have capacity utilization moving up from 65, 70 to 80, 85 or 90, the kind of profit growth in these companies can be multiples. The profits can double, triple also. And you also have a scenario where there is definitely cost benefit which is coming in. A lot of these cement companies use diesel as backup power. A lot of them use coal, the prices of which have fallen. And I think the cost benefit, even transportation, with diesel prices falling between 10 to 15 rupees a litre, the benefit for these companies, no one is even comprehending. So I think from our perspective, the profit growth in a lot of these companies will surprise, and the valuations are in our favor. I think liquidity is important for someone who wants to buy them for 15 days. I mean, we are long-term investors, and we believe that we are in the cusp of good growth over the next 5-10 years, and it makes sense to just have a buy and hold strategy.
So whether it's IT, private banks, midcap cement, or select FMCG names, do you think the core of your portfolio will remain constant for next 3 to 5 years?
I think more or less, unless the valuations, move dramatically up and down. But at the same time, Nikunj, our job is on a day-to-day basis to evaluate the best value of every rupee we manage. So I think there can always be changes in view depending on the circumstances. The world is very dynamic. India is very dynamic. One theme other than what we have mentioned we like is the urban consumption theme. I think urban after 5-7 years is showing signs of growth higher than the rural India. And I think there is unsatiated demand in the urban side with increasing visibility for growth, increasing visibility for jobs.
Inflation is also down.
Inflation is down. So even conveyance for someone like someone in Bombay having even one car, the saving is at least 5,000-7,000 rupees a month minimum. So I think that those kind of savings will lead to urban consumption definitely picking up.
No, that's a great point. So last 4 or 5 years, because of Narega, because of higher MSP, the rural consumer has benefited. Now because of low inflation, perhaps job creation, the urban consumer would benefit.
Perfect.
So buy into pizza companies, buy into donut companies, buy into call centers, buy into restaurant companies. That's the urban consumer. That's what you should back now.
I think I don't want to get into specifics, but we are all staying in cities. We know what we consume, and I think that is the best research we can do. Obviously, the valuations of a few companies would be a little bit difficult to digest. So there also, it becomes very, very essential to look at companies which can grow much faster. So I think from our perspective, paying a slightly higher valuation is fine as long as the growth can be substantially higher. And I think that is where the focus is.
The consensus view with the retail investor is, oh my God, I missed the bus. Should I come now? Sensex is up 50% from the recent low. Your funds have appreciated by about 80 to 100% across categories. So for someone who's coming in for next 3 to 5 years, how exactly is the risk reward ratio mapped?
See, one is it's always a very difficult question for investors whether to come now or later. The same thing was the case when Nifty was at 5,000. The same is the case when Nifty is at 8,700, and the same will be the case when Nifty will be 10,000. Having said that, I think what our advice to an investor is that as long as the economy is growing, as long as you're clear that this $2 trillion of GDP of India would ultimately reach 4 trillion. If you're bearish, it would take 10 years. If you're bullish, it would take 6 years. I think if that view is clear, you will make good returns as far as equity markets are concerned, and any time is a good time to invest. Having said that, whether they can be 5-7% reaction, they can always be 5-7% reaction. But we don't foresee any major crash because there is still a lot of skepticism, across this so-called bull market. And I think bull markets don't die in such kind of skepticism. The other thing is, yes, earnings have disappointed, but despite that, we are not looking at 25 P or 30 P. We are still at a 6, 17, 18 P 1 year forward, and maybe 15 or 14 FY17. So we are not very, very expensive. The other thing is the composition of the Sensex itself has changed dramatically. That's why the PE looks a little higher also. Yes. Earlier, so-called commodity stocks used to be 30-35% of the Sensex. Now they are less than 15% of the Sensex. The so-called high PE stocks or sectors used to be very small. Now if you see pharma, IT, private banks, you look at consumption stocks, they are a bigger percentage of the Sensex. So obviously, the PE of the Sensex per se, you can't compare with what it was 4-5 years back. It will always be a little higher. I think we have to keep that in mind. And if you keep that in mind, our view is that mid-teen returns on a consistent basis are possible.
That's such a valid point. I mean, JSPL will not be part of the Nifty going forward, and Asian Paints has just entered into the Nifty about 3 years ago, and we know the P multiples for Asian Paints. Let's talk about some of these consumer names. You've never liked them, but that's where all the excitement is. That's where all the fun is. So as a fund manager, are you regretting not buying into them, or are you okay with that?
See, life is so difficult. You are never happy about anything, or everything on a particular day. Having said that, I think our call on the general consumption theme from the time we took has played off well. We replaced it with pharma. That was a call we had, that the similar quality of companies, one category growing faster and available at a significant discount to the others. And actually, if you see, save for 3, 4, 5 consumption themes which have really zoomed in the last 4-5 months, I think generally the segment, at least the larger companies, have significantly underperformed the pharma segment. So I think that has worked. Having said that, as I mentioned earlier, we are positive on the urban consumption theme, and we have a lot of urban theme consumption stories in our portfolio which have given very good returns. So whether it is the alcohol segment, whether it is the retail segment, whether it is even the sanitary ware or the home building segment, and we have been successful in creating a lot of alpha in a lot of these companies.
Broadly, there are a lot of pet sectors which Prime Minister Modi seems to be backing. Made in India, Swachh Bharat, smart cities, digital India. Which is the big theme which you are also backing, assuming that big mega reforms would be unleashed going forward from this new administration?
See, every manufacturing company is made in India. So technically the whole market benefits out of it. Having said that, as I said, we are backing engineering companies with clean balance sheets. So if you see across the portfolios, find a lot of stocks where we have a decent exposure, but the balance sheets are clean. As I said, there has to be foreseeable earnings in a lot of these companies, and operating leverage will play a big part in that thought process going forward. That is definitely one theme. Railways, we are positive because companies again which are listed have absolute very small market cap. I don't think the total market cap of railway specific companies will be even $2-3 billion. So there is definitely an opportunity there because it's such it's like the lifeline of the country. So there we are definitely banking. I think Swachh Bharat, I don't know how to play. There are not too many listed companies, and as I said, you have to definitely play the themes, but it has to come at a valuation. If you are buying stocks at 100 PE, I don't know when you will make long-term profits. If you're lucky, maybe someone else will come and buy it 30, 40, 50% more expensive than from you. But ultimately, the visibility of earnings becomes very, very core. And as I said, the investors would be satisfied after 100% return to make 15 rather than 18, but that 15 in a more sustainable, secure and a proper thought process perspective.
The good news for the mutual fund industry, and I'm sure that's applicable for your fund, is that outflows have become inflows. Can I say that for the mutual fund industry, not Achhe din, bahut achhe din aa gaye, is the average retail investor back?
I think what we have done is just recouped what we lost in the last 4-5 years. But in the last 4-5 years, the cumulative savings from Indians is exceeded $1 trillion.
So we have a long way to go.
Very long way. And the good thing is that now investors are realizing that buying these hard assets, whether it's real estate and gold, is expensive because you have to spend money to sustain them. If you're in equity or fixed income, you get either dividends or interest on an annual basis. And I think that realization is there. The good thing is that the investments which are coming now are much more matured and much more sustainable. And we hope that going forward, in fact, we are very confident that the size of the mutual fund industry or the domestic institutional investors would be multiples of where we are today.
Every time Sunil Singhania comes on TV, which is rare, he's expected, and every time he opens his mouth, he's expected to give a big call.
So, see, I think, from our perspective, as I said, sustainable earnings basically becomes very, very important. I don't know what big call to give. The big call which I can give is that have confidence in the country. I think if it is not going to happen in the next 5-10 years, it's never going to happen. The other thing is we have to see India in relation to the other countries. Everywhere there is a possibility of interest rate hike because they are already at 0% interest. India is the only country where we can have 8, 10, 15, I don't know how many rate cuts. So, keep that big picture in mind. Don't get swayed by, some Greece event or some budget event or XYZ event. Those events come, they are forgotten very, very quickly, and then we move ahead. So I think the big call from our side, frankly, is, have a little bit of positive view, stay invested. And as I said, the themes are very clear: operating leverage and urban consumption. They look to be the bigger themes as of now.
And just to talk about the power of compounding, if someone had put in 1 crore in Reliance Growth Fund 20 years ago, that has now become 82 crore. That's a magical return, 25% CAGR return. Can you deliver that again?
I don't know because we are not allowed to give forward-looking statements.
I have the data.
But if you imagine if this were to happen again, this 1 crore will become 6,000 crores. And I think that is what the power of compounding and staying invested for long periods of time is. So I think the advice to the investor is that believe in your country, believe in your investments, and become passive investors. Just invest and forget about it. You will definitely generate good returns.
Sunil, wonderful to have you on ET Now. Thank you for joining us.
Thanks for having me. It's a pleasure.
That's it on this edition of Market Makers. Nikunj Dalmia signing off. Thank you for joining us.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.